So my friends, now let us look into the deduction for livestock. If I have got some livestock which I am using it in my business, do I get a deduction from my business profits? That is the question. Remember here, my friends, we are not talking of that livestock which is a stock in trade. We are talking of livestock which would have the nature of an asset for you. This is not the livestock which is stock in trade. This is that livestock which is in the nature of an asset. For example, if you got a poultry farm and you are buying and selling chicken in the poultry farm, then that is typically a trading transaction wherein the sale of chicken is your income and the purchase of chicken will be treated as a normal expenditure. Correct? But when the livestock is being kept as an asset in your business, then what exactly is the treatment? What would be possible examples of livestock being kept as assets? Take for example a dairy farm where buffaloes are kept. So the buffalo in the dairy farm is not meant for buying and selling. It is not your stock in trade. It is your fixed asset. Milk is your goods which you are selling and getting income. So the livestock is like a machine there. The buffalo is like a machine which produces goods, and therefore if machine is a fixed asset, the buffalo also has to be a fixed asset. So this is one example. We have many such examples, like for example security guards. In security agencies, the security guards etc., they are given dogs. The dogs could also be livestock which is ultimately a fixed asset. Those dogs are not meant for buying and selling. They are meant to be used as assets in security services. So these are examples of livestock being fixed assets, and the provision which we are looking at 3616 is only for those livestock which are fixed assets. They are assets and they are not mere stock in trade. If it is stock in trade, I have told you it's a simple transaction. When you sell the livestock being stock in trade, you get sales income, and when you purchase the livestock, then that is a purchase expenditure. The profit on sale and purchase, the profit is being taxed as your business profit. It's a very simple transaction. But what to do exactly if the livestock is not stock in trade? It's a fixed asset that we'll see. So remember, the first thing to know is that look, livestock is not a depreciable asset. We cannot charge depreciation on livestock because it's not a depreciable asset. Have you ever seen an entry which says to depreciation on buffalo in the debit of the P&L? No, because the buffalo is not a depreciable asset. And if you think buffalo is a depreciable asset, I'll say you are donkeys and you have suffered 100% depreciation on straight line method in your brain at once. And I know that is not the case. I tell everybody that look, my online students are most intelligent in the entire universe. Don't even think so. So cutting the persiflage and coming back to the provision of livestock, let's see. Remember my friends, in the purchase year, when you purchase the livestock which is a fixed asset or any other year, later year, there will be no particular deduction or no depreciation also. Reasons are obvious, which we have already discussed. But the deduction will be available in the year in which the animal dies, the animal is sold, or the animal becomes permanently useless like most of us. So remember, you'll get a deduction in the year in which the animal dies, animal is sold, or the animal is permanently useless. Purchase year, later years, no deduction, no depreciation. Year of death of the livestock, year of sale of the livestock, year in which the animal becomes permanently useless, then in that case you will get a deduction, and the deduction is very simple. The cost of the livestock is what you had invested in. In case of a normal machine, you get depreciation to recover it. Livestock, that is not possible. So in the year in which the animal dies, sold, or becomes permanently useless, you take whatever you invested in that particular livestock, the cost of the livestock. From that, you subtract the scrap value or the sale value, as the case may be, and that difference will be the deduction under section 3616. Now, many of you are thinking that look, what exactly is a scrap value? So I'll explain it to you what we mean by scrap value. Try and understand, in dairy farms typically when a buffalo dies, what happens? The dairy farmers have a contract with the leather factory that the leather factory will come and take away the carcass. The leather factory will come and then they'll take away the carcass, the dead body, because they will use that, the skin, etc., in making shoes, etc., whatever they produce. So, let us say the buffalo cost you 50,000 rupees when you purchased the buffalo. When the buffalo died, the leather factory people come, they take the carcass and they pay you 2,000 for that carcass. That 2,000 is indeed the scrap value. So the net loss which you've suffered on the death of the buffalo is the cost 50,000 minus you recovered 2,000. So the net loss which you've suffered is 48,000, and that 48,000 is a deduction under section 3616. Okay. Now those who are sitting there, they'll be thinking that, look sir, what if the buffalo dies, we don't have a contract with the leather factory and we incur some cost to dispose of the dead body? In that case, that will be allowed, the expenditure for disposal of that dead body will be allowed as a general expenditure under section 37(1). So it will be allowed as a general expenditure, that is the routine expenditure which we claim under section 37(1). Okay. And those of you who are really working your brain will think that, look, what if the sale price of the livestock exceeds the cost of the livestock? Then what? Here we are looking at a case where the sale value is below the cost. What if the sale price of the livestock or the scrap value of the livestock exceeds the cost of the livestock? Then what? Then can the profit be taxed as a business profit? For those livestock which are fixed assets, the answer is no. Remember, the livestock which you are using in your business as a fixed asset is a capital asset, and if the sale price exceeds the cost, then you will have to go into the computation of capital gains. That's the answer. So, if the sale price exceeds the cost of the fixed asset, livestock being a fixed asset, then you've got to go into a capital gains computation. Now, the next question is, so how do I decide whether the livestock is long term or short term? We've got a period of holding of 3 years. If you've held the livestock with you for a period more than 3 years, then the livestock is long term. The next question in your mind is, would we index? Would there be indexation? The answer is yes, because if you read the provisos to section 48, that is the mode of computation of capital gain, there is no mention in any proviso that the livestock, when it's a capital asset, and if you are computing the capital gains on a livestock, no indexation will be allowed. This is not mentioned in any of the proviso, and therefore, if the time comes, yes, you will even index the cost of the livestock. So I tried to cover all the possible aspects in this discussion. Hope you enjoyed it, and we will meet soon.